What's going on, YouTube? In this video, we're going to talk about how to make passive income while you sleep with only a few touch of a buttons that is even safer than dividend stocks. So if you want to watch the rest of this video, I encourage you to do so. Before we get into it, jump right into all the good stuff. My name's Tyler. Hit the like button and the subscribe if you're new to help push this video out to more people so we can help their portfolios as well. Now, there's a lot of new traders this year that think it's either high risk growth stocks or low yielding, mid yielding dividend stocks. That's all you can do to make passive income, and that's just not the case. So in this video, we're gonna break down into that and what I personally do. So stay tuned and let's go. I'm not ragging on dividend stocks or the growth potential they have, especially if you have dividend reinvesting on over the course of 10, 15, 20 years. That just alone, dividend reinvesting can grow pretty much any amount you had invested into a significant amount, as long as the company has good fundamentals and the stock price keeps going up, at least over the long term. You know, we don't care what happens in the short term. But with that though, a lot of dividend paying companies, they're just sticking around. They're not really growing. Their share price kind of just balances out. So you really only get the yield, and some years the stock will go up, some years it'll go down. So the yield, basically you break even. The way I look at it is you break even, and then your dividend reinvestment is what really starts to compound the growth. So I don't recommend not having any dividends. That would be dumb. Now, if you want to get more interactive with it and potentially make more, then this strategy is going to work better for you. And this is what I do, and that is selling covered calls. So the key with covered calls though is you need a company that has high IV, that doesn't relatively move a lot, because if you sell covered calls on a stock, that essentially means you agreed to sell your shares at the strike price that you sold it at. So you collect the premium, whoever bought it, and you agree to sell the 100 shares at that strike price. Now, if it's a stock like GameStop, you don't want to sell one and then, you know, get burned because you could have made so much more. That was just a joke, but it was a bad joke. But there's better companies. Like if we take a look, some of the companies that I do this on. Now I want to do this on Neo, but I have a really good cost basis on Neo, and I just want to see if it'll come down. But Big Commerce is one that I want to start selling covered calls on. I have 44 shares, so I've spent $3,034 in this position. But Big Commerce moves a lot, so it has very, very good IV premium. But their calls, they have like one a month, so they're kind of spread out more. But if you had bought Big Commerce like I did in the $65 range, and you could sell this and agree to sell 100 shares at $80 and make what, 25-30%, I'm not sure exactly the math, I think 25%, and collect $853, so really you're making even more than that. You're making more like 30%. And if it never hits $80 or goes over and closes under $80, then you will keep the premium. But I actually have examples of these that I have done. But like UWMC, it just was a SPAC, GHIV, it merged into UWM, and now this company has very good IV. I was very surprised on how good the IV is relative to how underappreciated the company is, and the growth aspects that I see in the real estate market, because this is a real estate stock. So the February 19th, I sold this. It's at 38 bucks right now. I think I sold it at 38. No, I sold it at 40. So you get 40 bucks for 2 weeks, and done deal. And I agreed to sell it at $15 too. So basically, and I bought them at $10.93. So I'll make like 450 bucks, worst comes to worst, and I'll keep the $40 too. For only a $1,000 investment, 40 bucks every 2 weeks, that is way better than dividend stocks. Way better. If you think it's not, run some calculations. that is insane. So year over year, if there's 52 weeks divided by 2, then you're looking at what? Just call it 25. 25 times 40. What's that? We'll do this real quick. Where's the calculator? 25 times 40. Boom, $1,000. You'll make 100% of your investment if you got $40 every 2 weeks on this company. You would make 100% of your investment and risk selling your investment for a $450 profit. That doesn't seem like a bad strategy for me. The only way you mess up in this strategy is if you sell the covered call get greedy and sell the covered call under your average share price for the company. So basically, if I sold like $7.50 contract, I would still be almost break even because I would get $355. But still, you see what I'm saying. If you bought these shares at $15 or $16, you wouldn't want to sell a $15 covered call because you'd lose money. Another one I like to do is Rocket Mortgage. This one I did a very far out the money one because I wanted to collect a lot of premium. I should have just done a couple weeks out, so I'm actually down $63 on this one. But it doesn't affect your actual portfolio value because it is a secured play. So I bought in at $22, and I would agree to sell 100 of my shares at $30. So I would make $800, worst comes to worst, and I collected $300 and some dollars, $315. So worst comes to worst, I make $1,100 on this trade. So that is over half my position. That's even a 50% return because this contract is for December of 2021. So 2021. So that's still 50% of your investment. I wouldn't recommend selling super far out the money calls. I was expecting Rocket Mortgage to go down. The real power in selling covered calls is you tie up this money into the shares, but can get a way bigger percentage gain, and it is risk-free comparative to your cost basis. So you can never lose more than what you invested in the company as long as you sell a strike price that is higher than your average cost. So if your average cost is $13 a share, don't sell a $12 call for $50. You would risk $50 would be your total loss that you can make on the trade. That would be a dumb trade. If you bought shares at $13, like we just said, and sold a $15 call, then you would collect the premium and keep the difference, $200, because it's times 100 per dollar in the strike price. So that's the real power behind it, especially if you have a larger account, even larger than my account, because my account's $18,213, and I have it spread out into a lot of different companies because I am not a fan of having a majority of my account in certain stocks. I do have 20% is my highest position of my total account value in any certain stock, and that is even high for me. So you get stupid market swings. Like I was at almost 19,000 today, and then within a half an hour I'm down to $17,286. So that kind of investing is not for everybody, and if I was the kind of person that was gonna sell out, then this is not the strategy for me. But I'm not. I'm holding for the long term, and I kind of laugh when it does this. Like when you see all these CNN articles and all this talking about the pullbacks coming and all that, that's a good thing. If you're a true investor, and I mean, be a trader and an investor, that's what I do. But if you're just a trader, I guess you might not like that, but for long-term investors, that's a great thing. I was hoping all summer long, sorry if this is gonna offend anybody, any of the bulls, but I was hoping for a market crash or a market pullback, and it just quite frankly never happened, and I never really got into a lot of the companies that I should have at a cheaper valuation, Tesla being one of them. I remember back in August, before the stock split, Tesla, when they announced, it was around $700, and I thought it was just too expensive, and quite frankly, it could have been too expensive even then. But since then, it's, you know, 8, 9, 10x, and that was something I should have got into. But my strategy keeps me safe and make sure I can sleep at night. So just putting that out there as a reminder for you guys not to get too carried away into different companies and sell it, buy in super high, and then once it starts going down, sell in. And even options, that's not recommended. But I think that's all I got. I think I covered calls pretty good. There's really not much else to it. It's a pretty straightforward, simple, easy thing to understand. At least it should be. So I guess with that, I'm gonna wrap it up. You guys have a great night, and if you're new to the channel, hit the like button and the subscribe. Don't forget to do that. Hit me down below in the comments what your passive income strategy is with the stock market. Do you prefer something like this? Do you prefer dividends, just long-term growth, no extra added income? Let me know down below. Maybe spreads, who knows? Let me know down below. And with that, I'll see you guys in the next video, and peace out.